We're going to move directly into our first session. The Canadian public markets have historically not been the first place that people look when they think about defense investment. That is changing, and it's changing quickly. A TSX listing is not just a financing event, but a statement of sovereign credibility. Our first session explores what this means for a company that has made that choice and what it also signals to the Canadian and government counterparties. Moderating session one is Omar Khafagy, the head of client success at TMX Group, where he serves as a trusted advisor to TSX and TSXV listed issuers and oversees the exchange corporate access program. Omar, I'll leave it to you.
Right. Good afternoon, everyone, and thank you to the Dentons team for partnering with us on today's Defense Capital Forum. As Manveer mentioned, my name is Omar Khafagy. I head up issuer relations for the innovation sector at TSX. And I had the pleasure of working with Abhinav, Singhvi, CFO of Volatus Aerospace, since the company's very early days as a publicly traded company, coming through the TSX venture in 2021. And what I'll say is Volatus is really a clean case study for the theses behind today's session. In 2025, the company had a share price appreciation of 279%. The company ranked on the TSX Venture 50 program as number 16, battling with plethora of mining companies on that program. And this past March, the company graduated to TSX. Along the way, Abby, you've raised $45 million in equity, grew your defense segment from 5% of revenue to around 25% today. I know you have an extremely jam-packed day today with your earnings coming out today. So first of all, thank you for carving out some time for today's discussion.
Absolutely, Omar. Thank you so much for having me and Denton's team for having me here, and very excited. Thank you.
So before we get into the public markets discussion, can you maybe give us a 30-second version of where Volatus sits today in terms of scale, footprint, defense mix in terms of revenue, and just give us a high-level overview.
Sure. Well, nothing scares me more than talking about the scale of the company in 30 seconds. So that's a hard one. So Volatus Aerospace, we are a aerial intelligence, autonomy, and defense company today. We have grown multifold in the last 6 years. We operate both crewed and uncrewed aviation. We have a fleet of 28 piloted aircraft and over 100 drones that's operating in Canada, UK, Latin America, US, Norway, and in the European markets. The focus has been started with aerial intelligence in the commercial sector, and over the period of time, we have diversified and scaled the business in the defense market as well. The real entrance of the company happened in defense back in 2022, but we, no pun intended, kept it under the radar, and it really took off last year when the government changed the mandate in the defense by the Canadian government really amplified.
So that's where you're at today. Let's maybe rewind to 2021. Volatus went public on TSXV as a commercial drone services and inspection business. Defense wasn't really a story yet at that time. What made public markets the right path for Volatus versus maybe continuing to raise privately?
A few reasons, actually. One is, if you look back at 2021, specifically the focus back then was commercial. The industry back then, and even to certain extent today, is highly fragmented and very diversified, consists numerous smaller players in the marketplace. So when we look back in 2022 at the market and the overall strategy, we realized that consolidation is one way to really capture and expand more aggressively than going just organic. So at the end of the day, the decision for us was, should we stay private, keep raising private capital from family offices, venture capital firms, or should we go public, which basically the biggest advantage for us was create an alternate currency. And for us to do M&As, equity was an important currency because it basically unlocked the scale for us. Also, since the industry was so nascent, every company we were acquiring the founders and the management team, the market was fairly new as well. So they also wanted skin in the game and upside and not just cash exit. So going public, doing M&As using equity, not just help Volatus to grow in scale, but also enable the different companies we have acquired to participate in the upside of the organization. And the second reason is, of course, the credibility being public brings in the company. We have always been dealing with utility companies, energy, government departments, public safety across different countries. And the moment you're public, it brings a different set of seriousness and credibility, because every time you're dealing with blue chip and large organization, governance is one of the major factor for those organizations to do business with you. And being public on venture in Canada basically enabled us to showcase and prove that credibility as well as an organization.
So I want to maybe double click a little bit on, using your shares as currency for M&A, because I think, you guys have had a pretty aggressive M&A playbook, executed about 20 deals over your time at Volatus. How has, if we can be a little bit more specific, how has being public shaped that playbook, and, where did it really help, and where did it get in the way of executing some of these deals?
Well, second answer is more easy, actually. I'll start with the first one. Being public, specifically when we look at equity, historically we have done M&As using cash and equity. So when I say that, there's always a breakdown and a balance. So I'll just take a random example. If we have a target X and if we are on the negotiating table, the buyer wants to sell at the highest price, the buyer wants to buy at the lowest price, and the seller wants to sell at the higher price. There's always a fine balance in between. Now, what's the best way to bridge that balance? That is basically equity. So Volatus, we have been very prudent. We always pay for what the execution history has been, but we also understand that the market is expanding, the industry is growing X-fold. So how should we reward the founders and the management of the target company? Equity plays a clear role, because every M&A and any M&A we have done, the pricing happens at a date, and the moment the companies complete the transaction, the entire rating of the organization changes. The revenue profile changes, the profitability profile changes, the balance sheet of the organization structure changes. So at the end of the day, equity plays that big role, because now it's not just the shareholders of the organization that gets rewarded for executing a prudent M&A, it's also the target company, the exiting shareholders gets rewarded. And the second thing is, the gap in valuation, we always address using earnouts. So, between the differential value, we always, and here's an example. If the seller says we'll do X million dollar and we believe what they have done historically, they'll grow 20% or 30%, and there is a gap, we say, okay, if you achieve X million dollar in revenue or X million dollar in profitability over the next 12, 18, or 24 months, we will reward you with additional equity as earnout in the organization. And at the end of the day, we empower those targets to achieve their goals, because it's win-win. They meet their targets and goals, they make more money, they get more equity as an earnout. And for Volatus, if we look at the enterprise value to revenue multiple, it only gets cheaper. So our M&A actually executes it, not just helps us in negotiation, it also helps in integration post-merger, which is basically the most challenging part. Now, coming to the second part, being private and doing deals is much easier than being public, because as a private organization, all you have to deal is with your internal stakeholders and investors, which are basically group of VCs who are backing a transaction. But when you are a public company, now you're not only supposed to deal with stakeholders and existing institutionals or large institutionals, but you also have to deal with compliances, regulatory requirement, filing, which of course come with its own burden and pain, and along with the audit, and then also with the narrative. Being public company, you have to execute on a longer term strategy, but be ready to get judged on a daily basis on a short term execution and stock performance. So it comes with its own toil and pain, which as a public company you have to deal with and navigate it.
So I'd like to maybe shift our focus now to your defense strategy and maybe pivot. As we mentioned earlier in the conversation, that segment of your business now accounts to roughly about 25% of revenue compared to 5% a couple of years ago. When did defense become a more deliberate part of your strategy rather than maybe an adjacent market or an opportunistic move?
So back in 2022, when the Ukraine war happened, that was the first foot in the door for us in the defense market. So we had the privilege of working with employees who represent Ukraine and with their families. And when the war happened with Ukraine and Russia decided to invade Ukraine, there was a lot of displacement in its own civilian population. And Ukraine really wanted to use drones in the initial phase to locate those displaced population and understand their own geography of what's happening and where the enemy movements are on the ground. So we developed drone technologies which are mostly ISR, intelligence, surveillance, and reconnaissance. And we developed those tech and shipped it to Ukraine. And that was the first foot in the door in the defense segment. We really realized that the technology is working really well is when, at the end of 2022, Russia decided to give us a Christmas gift because they came up with a list of 100 Canadians that was sanctioned from entering Russia. My CEO was number 11 on that list. I'm number 13 on that list. And our entire Volatus... Thank you. I do wear it as a badge of honor as civilians. That's the least I think we all could have done. But for us, that was a reality calling, and that's when we realized the technology that we have developed in the commercial market have an equal important role in the ISR defense market. Fast forward from 2022 to 2025 now, we were serving that Ukrainian market in ISR space, but Ukraine had evolved way beyond ISR. They went into interceptor, kamikaze, one-way drone technologies, and those were not really the segments we wanted to enter in because of the sort of restrictions as a Canadian company. But last year, when our Prime Minister stepped on the podium and said, Canada has to step itself in front of the defense, develop its own defense technology and the industry, for us, that was almost like our entire addressable market expanded because we always had that customer base who were demanding technologies which can be used in the war zones, and we always restricted them for ISR purposes. So since last year in May till now, we expanded our addressable market. We started working with not just Ukraine, but also with different NATO allies in providing drones, in providing services, in providing training on how to operate those drone technologies. And that was basically for us the real growth accelerator that happened last year.
Amazing. Now, I want to come back to March 20th. That's when Volatus graduated to the main board, the TSX. 6 weeks in now. What's the most material change that you've seen, and what hasn't changed that you expected it to actually change by now?
What hasn't changed? I think my world is upside down, so I think everything has changed. That's for sure. The biggest advantage, and this was a cautious decision that the management and the board of our company took while graduating from TSXV to TSX, was more eyes on the stock and more institutional investors' visibility. As a venture company, it's a perfect platform to start the business, to scale. And once you hit a stage of scale, the level of interest changes by the investors, the profile of institutionals change, and also when you deal with different government, the seriousness by which they look at you also changes. So for us, getting on the TSX was one, a move to get more serious on the institutional side. Second, and that's the most important part, was we were talking to a lot of institutional investors, and the one feedback we kept getting was, we cannot, by their own mandate, they cannot invest in Volatus because we were a venture company. So we had to push ourselves from venture to TSX so that we can start inviting and have those institutional participate investing in the organization, whether directly or through secondaries. The third part was, as we get uplisted, it of course comes with its own compliance and governance complications, I would say, because now the company's reporting profile has changed, the internal control profile has changed, the auditor lens changes as well because now you're trading on more senior exchange. The timeline and the deadline changes. All of a sudden, you move from 120 days annual reporting to 90 days annual reporting, 60 days quarterly reporting to 45 days quarterly reporting. And it comes with its own, I would say, pain and pleasure at the same time. And it's a fine balance that you have to do as you uplist the company. So graduating to TSX it's never been an end goal for us. I think it's for us has been a step, a direction, because all we wanted was access to a larger arena and a larger strike zone.
Now, on the disclosure side of things, now with you operating more in the defense space, there's a little bit of tension because your investors want more transparency. Your customers probably want the opposite. How do you navigate that?
Well, I always say customer first, right? So we always listen to our customers. And this is something, it's very common in the defense industries as well, is a lot of contracts we win are confidential, where we are allowed to speak only so much, and we have to honor those contracts at the end of the day. Yes, investors do expect, including the institutionals, retail, and the analyst, to disclose as much as possible so that it's easier for them to forecast where the company is heading, where the financials are heading, where the growth of the organization is. At the end of the day, it's all about the intrinsic value and the fundamental value of the company. But for us, we have to be very careful, and that's a fine balance actually, is how much do we want to report versus how much do we don't want to report, because purely excessive reporting not only comes with the complication with the customers, but also creates more competitive disadvantage because a lot of our competition are private companies. And when we deal with those private organizations, they have no disclosure requirement. And when we start disclosing way too much, even let's say on the margins, how much margins we do on services, and if we start getting into details of those margins, it's very easy to back calculate what the margin of individual segments could be that could lead to adverse competitive advantage or competitive disadvantage for us as we move forward. So there is no straight answer. I think it's a fine balance we always manage. We always try to make sure that we report as much as possible to create that transparency and good governance. But at the same time, we make sure we don't over-report ourselves, over-disclose ourselves, that gets us into problems with customers or future business opportunities for the company.
Now, you've raised over $45 million in 2025 through bought deals, live financings, convertibles. Defense backlogs convert to revenue on procurement timelines, not capital markets timelines. How do you think about sequencing your capital raises against operational milestones in an environment like that?
I think and this is something we have seen, is the classic mistakes public companies do is wait for the procurement timeline to convert into potential orders and cash flow, and then go for a raise. We feel that's an incorrect or wrong strategy, because when that happens, you're not always in a window of opportunity when it comes to raising capital. You may not always raise capital at the right pricing. So it could actually backfire for the organization. Now, we do realize, Volatus being in that space today, we do realize that procurement timelines are 18 to 24 months, sometimes can also extend to 36 months period. So one, the business we are building, or any company, has to be diversified so that the entire business or entire capital raise is not dependent on one customer or one group of, I would say, defense customers or or a country. So it has to be more diversified, which we bring because we are a commercial company. Our foundation has been commercial revenue when we started, and that's still the commercial revenue. I always call it as big, dull, boring revenue, which I love because it comes with free cash flows and stronger EBITDA margins. Defense has its own procurement timeline. The capital raise, the timing, has to be opportunistic, has to be very timely, because in capital markets, windows open and close very quickly, and no one really knows when the window is going to close. So when the window is open and when there is investor interest, all one has to do is be transparent about the procurement timeline, be transparent about how the capital is getting deployed in short term and in the long term, because it may, though capital raise may not get deployed immediately on a procurement contract, but at the end of the day, one thing that follows a procurement bigger contract is capability, infrastructure, and capacity. So the capital that any entity is raising has to go in these three layers or foundational pillars, because if any organization has these three pillars, the procurement contract will follow, whether it's in 6 months, 8 months, or 12 months.
Awesome. Now, last question, and we'll let you off the hook. There are issuers in this room, companies that are pre-IPO, that are thinking about their own pathway. Knowing what you know today, what would you tell a company weighing the option between, a TSX or a TSXV pathway or staying private, and what's the one thing you'd warn them about?
I would say going public, whether it's be venture exchange or TSX, TSX comes with a scale. So if it's a pre-scale or in a growth phase, TSXV is the right answer. So when it comes to going public, the biggest thing is, what is the long-term strategy? Do you have the right leadership team? Do you have the strong governance established and placed? And what is the end goal? Why are you going public? Those are the, I would say, 4 questions you need to ask yourself. Because if you have everything in place, going public will amplify the value and accelerate the scale of an organization, period, right? Investors will back the organization, the stakeholders involved will back the organization, the customers will back the organization. But if you're not ready, if you don't have any of these one thing, I would say wait until you have that in place, because if the fundamental value of the company is weak, the exchange will also amplify that part of the exposure, right? And that gets reflected in the long-term stock price of the organization. Now, the other aspect of going public is, as I said, it comes with its own complications, compliance, timeline, cost, and I call it as taxing events on your operational team or the administrative team. So you have to be ready for those aspects. The one key aspect is you need to keep executing, period, no matter what. Whether the window is open or closed, whether the market is happy or unhappy, broader with the industry, with what's happening, because at the end of the day, you are susceptible to the geopolitical situation at the same time, which private companies so much are not. But the most important thing is you'll be judged on the execution on the long term, but on a daily basis, you will be penalized sometimes or even rewarded for the things you're doing or not doing, and that gets reflected in the stock price. So perseverance is one of the major, I would say, criteria. You need to be focused, you need to keep executing, you need to keep doing what you're doing without getting distracted with daily volatility of your stock price.
Great advice. And thank you for being transparent. That was a great conversation. I know capital pathways, M&A, procurement, capital defense, these are all themes that will come up again today. But please join me in thanking Abhinav for a great conversation. Thank you.